Greetings, good people. Jonathan Camarda, your humble CIO. My purpose of this video today is really twofold. One, give you a quick market update, and then also express the thoughts behind the strategies that we deploy. So you get an idea into the methodology, not taking it too deep into the quant. And this comes across, so this way you have a better idea of the game plan and how we run things. And I think that that would also help communication as well as you're looking at the strategies you're in and the appropriate risk appetite determined by yourself and your PWA. So let me just start off with a quick market update. I'm not sure about you guys, but my neck's hurting a little bit from the whiplash over the last couple of days. Obviously, we've seen a rebound, from the geopolitical situation over there in the Eastern Bloc. Still risk, of course, when you're in a situation of potential war there. However, the market generally does react decently once there is some determination of what's going on versus the gray area uncertainty. Still far from out of the woods as the market is in a corrective phase. Still all the major moving averages, which we'll get to when we describe strategy, are beaten down. Now, the things that are maintaining strength are energy and agriculture, as we have exposure, certainly in that former area pretty nicely in your strategies, and that has actually helped hedge this year. If you look at your year-to-date returns, your PWA can get granular on the Orion platform to do so. However, we are also looking at the value stocks, right? You're basically your consumer staples, your utilities, those type of companies have done extremely well versus the more aggressive growth companies that really dominated from 2020 right through about Q3 into Q4 of last year. So your value companies have been outperforming. Now, very, very smart quantitative people are looking at that trade may have gotten a little overcrowded, and maybe we see a rebound in the more aggressive growth stocks. Not the crazy ones that did well post-COVID, but more of your semiconductors and large technology stocks that perhaps have been thrown out with the bathwater on the pre-Fed, game plan of what will happen. Of course, nobody knows exactly. Stay tuned for March when we get the first highlights from Jerome Powell. Now, so that's where the market is. From a structural standpoint, still the risk reward is to have some hedge, certainly in your commodities and metals to go with the equities. And again, fixed income, not really a great pain solution in this situation. It has been the last few decades because of the rising yield curves concern. So we've definitely had to widen out the toolbox. Now, how that pertains to strategy, the last several weeks from January into February, we began hedging and raising cash. So the platform that we use, again, the indicator is pretty sophisticated software. As we get indications, and then of course we put some actual thoughts from the CFA and CMTs on board here in the committee to actually ascertain what is the proper risk-reward structure that we should have. So we began selling in January, took a little bit of an opportunistic aggressive run as the market rebounded, as you recall, late January into early February, and then began again to go backwards in playing some defense there. So again, when you look within your accounts, this can be confusing sometimes, as you may look at an individual position that you may have sold right at a higher price, and then you buy it back, and then you sell it at a lower price, and it may look like there's a lot of checker moves, but we're just trying to edify you on the grand scheme, the macro chess mindset that we have. The individual positions in this type of market are not of concern. It's really when you look on a down day, look at your accounts versus the markets and as such, so you can get an idea of what they call in Wonkland the daily value at risk, and these tend to add up. So as you look at your year-to-date results in a downtrend versus the major indices like the S&P 500 and NASDAQ, that's where we want an attractive, what they call downside capture ratio. What that means is if the market drops 10%, and if we can drop less than that, we want a less than 1 ratio. Okay, I'm probably getting a little deep on a Friday, so I don't want to drive you guys out to dinner a little early tonight on that, but so that's as deep as I'll go there. So the individual moves, think of them as plays in a baseball game. But ultimately, if you have more runs than the other team, that's all that matters. Now, another thing, though, we are sensitive to that as the same positions generally getting in and out of, where we expand the horizon of actual instruments and exchange-traded funds, in this case, that we're using. Again, keep in mind there is virtually no more commissions, so that's a non-issue. And if you're in IRAs, there's no taxes until you take the money out, what we call TNT, power of TNT. No taxes and no transaction cost, pretty much virtually. So though I know psychologically, though, a lot of clients will look at individual price moves and as such, and that's something to discuss with your PWA, certainly to make sure that you're in a proper strategy because it is your money and your opinion ultimately is what counts. Our job, however, is to play the long game and to make sure that we do have as effective as we can downside market control. Control not being in the sense that we have a joystick, but in the sense that we want to certainly squeeze the guardrails of risk as we maneuver through this basically gray area of unforeseen territory. We're on the brink perhaps of a war, maybe not. Markets do well in those environments, maybe not. The Fed, right? Are they going to lift 5 or 7 times? We don't know. And remember, before the Russian-Ukrainian situation, that wasn't really what caused all of this. It's basically the fear of an inflationary situation. How far does the Fed go to rein it in? And then does that cause a potential recession into 2023? So that's a little bit behind the scenes of what we're looking at there when we're looking at the proverbial 10 screens with a hunk of either and a loaf of bread and pushing buttons sometimes when you have questions on. So I hope that gave you some insight. Again, things look bright on a day like today, but in this type of market, as you know, could have a neck brace because Monday could rip to the downside. If you have any questions, again, on your specific allocations, touch base with your PWA. Otherwise, we will roll up our sleeves and continually be eternally vigilant for you. And again, we appreciate your time, patience, most importantly, your trust. Stay frosty. And until next time, Jonathan Camarda.